Ladies and gentlemen of the crypto space, we're live on a Monday, June 26th at 11:36 a.m. The captain is back in action. I was disconnected while connected, and it was nice. It's nice to break away and try and clear your mind of everything that's going on. But it's important to stay connected to understand at least generally what's going on, but in a different way. Less attention, able to relax and reflect and gain hopefully a different perspective on things. And that's the whole point. It's imperative to take a vacation and to decompress. But I come back and I see very interesting data because I didn't look at any charts while I was away. But today I'm looking at charts and I like what I see. I like what I see from a comfortability standpoint, and that's the most important thing because comfortability multiplied by time, you're going to be heading in the right direction with having made good choices. And that's why we're here. We're here to make good choices about which assets that are meaningful. And I'll start with this experience. What are meaningful assets? Bearer assets, things that you possess. Why? I've mentioned on Twitter a couple of times about a bank, a regional bank, that has denied me access to a particular account for going on 2 years now. And I had to go through courts, and I got a court order. And it's been 5 weeks for the bank to respond to the court order in any way at all. And I'm at the end of a wit's end, the end of my rope of patience. They have denied me access to capital that a court has said I should have access to. So that plays very well into my opinion of digital bearer assets. No one could tell me what to do with them, where to send them. I'm in possession of them. Even the stuff that I have at a brokerage, a Fidelity or a Charles Schwab, you don't have access to shit. You have an account that they could lock and confiscate. So all of this experience with this bank just makes me more comfortable with the things that I've done over the last years, the assets that I've chosen to hold, possess, accumulate, define as money or spending currency in a different denomination other than what the Gen Pop defines as spending money or currency, as dollars. As long as it's liquid with dollars, that's all that matters. If you walk into a store and Ethereum is instantaneously convertible to USDC, and USDC is instantaneously loadable on a debit card, and that debit card is instantaneously usable for a payment, doesn't matter that you had your cash in Ethereum form or USDC form. You know what matters? That you didn't have your fucking money in a bank, because that bank can deny you access to that money for whatever stupid reason they could think of. There's my lack of comfort right now, is that experience I had with that bank. Quite discomforting that I even had to have a U.S. court involved, and I still can't get access to the account that doesn't have any money in it because they're liabilities, and the bank doesn't even have it. I don't even think the banks know what money is anymore, and certainly the people working at the banks don't understand. Let's pop it over to the main screen and take a look at some data to help us with our comfort. Oh, the screens are all messed up today. All right, let's do my best. So this is probably the most comforting indicator that I look at. One, directionality. Two, there's no more breath to the upside. This thing's not moving up. And then obviously we get to what this is. But look, it's not moving up. It has failed to hold support on the monthly TWAP. Directionality continues until capitulation. That is a heck of a shooting star candle. 1, 2, 3, almost 4 months ago. So we have confirmation candles suggesting that TWAP is not going to hold to the upside. That TWAP is that green line that you see right here. Plus, we breached it to the downside like 5, 6 months ago at this point. and it failed to hold. So this has top pattern written all over it. Directionality reversal. And when this moves down, I've covered this in other streams, when there's a breach of the TWAP to the downside, there's months of continuation to the downside. Many months, but once you have your confirmation. Look here, back in 17, breach to the downside. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 months before it started pushing up. What was going on in 17? 17 was an interesting year for crypto markets. We didn't really understand what we understand now about crypto markets and liquidity. That wasn't a story that I fully understood, a story that I definitely wasn't telling back in 17. But look at that. You'll find that if you overlaid crypto bull market periods, that would coincide very nicely, inversely, with this chart. When this chart is going down, crypto markets are going very up. And you can see that in the DXY as well. I don't have, here, I still have my little purple boxes. My little purple boxes. When the DXY is going down, crypto markets are doing very nicely. Why is that the case? And that's probably the biggest observation I've had since 2020. And this has been the case since 2008, as Mike Howell and Raoul Pal talk about probably most recently in the last couple of years with their content. Even not last couple of years, last year with Raoul's Everything Code. And it's this word liquidity. So liquidity, that was part of the title of the stream, is kind of abstract. It's kind of general. You know, you don't know where the cash is, but you could generally get a sense of how much capacity the system has for cash to be available. Think of it like a sentiment. You can have a sense that, there's going to be more cash in the system. What does cash do when it's available? It does things. So the crypto markets are a very easy way to do something with cash because they're permissionlessly accessible from anywhere on the planet. So when there's excess cash, we've seen great correlation with upward appreciation of crypto assets in general. So why do I look at the move indicator? When this indicator comes down, this is a forward-looking indicator of international liquidity conditions. When the volatility in U.S. bonds decreases, it means people that have them, actors that have them, are like, all right, there's less volatility. Let's put them to work. What do you do with bonds? Outside of the United States, U.S. Treasuries are converted to U.S. dollars. U.S. dollars are predominantly dollar liabilities in circulation globally. The vast majority of dollars are just liabilities. So the point is, U.S. Treasuries are converted to U.S. dollars. And then you get into other complexities about availability of paper currency, so on and so forth, and that's expressed in the DXY. When there's dollar shortage, it hits the Forex markets, but when this goes down, the world is able to print dollar liabilities, which takes the pressure off Forex markets. So this is a forward-looking indicator on the DXY, and the DXY is yet to put in a significant top, at least on the 6-month, but which is 4 days away. If we get a confirmation candle, and this candle closes below 103.381, we have candles matter. Candles are important. We have a confirmation candle of directionality reversal following the most massive shooting star on the DXY since 1985. Even if we go into the monthly, let's zoom in a bit. We're below the TWAP. That is consistent with directionality reversal. TWAP failed to hold to the upside. It's flipping a previous support into resistance. And there was very little support, actually. If we see move continue to go down, we're going to see the DXY lock in directionality to the downside. So over the next 2-3 years, you'll see continued decline of the DXY, which is continued appreciation of foreign currencies in general. Obviously, the DXY is predominantly Japanese and European fiat currency. Other minor components, but then those currencies appreciating filter throughout the rest of the system, and generally the dollar is weaker and other currencies are stronger, which gives them more purchasing power, which means there's more liquidity internationally. If you see the move go down and the DXY go down, there's more purchasing power outside of the US. To top it all off, so there's like trifecta of bullish conditions. So if you see collateral volatility going down and dollar value relative to foreign fiat going down, and then you see domestic liquidity conditions with, it's hard to get this chart to display right, but generally speaking, domestic liquidity conditions have also significantly improved. And that has to do with the way the central bank manages artificially available liquidity conditions. It does that vis-a-vis reserves, which is a relatively new concept since '08, as well as its balance sheet, which is balance sheet is basically the conversion. As it buys these things, it adds reserves to the banking system, and whatever. The whole point is it's an increase of supply of either collateral or currency indirectly. And that's meaningful because this is liquidity. It's by the BTFP, by the Fed and FDIC intervening in the evaporation of bank money at the failed banks this year. When you intervene in the destruction of money, you're adding liquidity to the system. So everything they have done has been to maintain liquidity in the system to such a degree that you visually inspect this chart and you see domestic liquidity conditions inside of the United States since December of 22 up 12.3%. So we could question whether QE is printing and what is money, because we have fun doing that. But all that matters is really the correlation between a variety of indicators of liquidity conditions and various assets and their price direction, their price action direction. As this chart goes up, as this chart goes down, as this chart goes down, crypto goes up. And that's cool. So there's our direction. Now there's plenty of reason, obviously, for this chart to have extreme volatility and maybe invalidate this directionality reversal. Japan could have a shit show. It already has a shit show with its collateral, its bond market, its sovereign treasury market. And Europe is obviously a catastrophe also. But that's the thing, they're all a catastrophe. The U.S. is just the least catastrophe of all the catastrophes. So you can be fearful of one of the catastrophes getting more catastrophic, or you can just follow the damn liquidity conditions and know that the U.S. is going to be the least catastrophic of all the catastrophes, which is basically what Brent Johnson talks about, that before all these systems fail, the dollar goes to the moon and all the other currencies depreciate against the dollar. But the question therefore comes to, how many cycles does the dollar have left? And as the contrarian that I am, I would say it has more cycles than the bears would like to believe. Doom and gloom. The dollar is coming to an end. The de-dollarization. Yeah. No, this thing's going to last a lot longer than people want to believe. Which means Bitcoin will remain volatile for a lot longer than people want to believe. And I don't want to get into too much of the Bitcoin narrative. I do like it as a bearer instrument. You own it, you possess it. There's no custodian, so you have no bullshit like I experienced with the banks. And now the question becomes, what are the preferred bearer instruments and what are the risk profiles associated with them? and which ones are going to outperform more than others, and what kind of functionality does the bearer instrument of choice that you have provide you? Do you have to sell it? Is it an enterprise? Is there cash flow? And that's why we've had that conversation of what assets to choose, and at least the methodology to choose particular assets versus other assets. So we started this stream talking about conditions and directionality. And if this directionality continues to reverse over the next couple of years, we're going to see improved liquidity conditions and general appreciation in crypto markets due to increased liquidity. And now we're back to the conversation we've had over the last 2 years of which assets to choose. So probably in 22, I was accumulating dollar liabilities, USDC. I have felt comfortable for the last month or so, maybe a little bit more than a month and a half at this point, predominantly just a bearer instrument, which is Ethereum. USDC is not a bearer instrument per se because there is counterparty risk, can be censored at the circle level. There's a variety of things to consider from a risk profile standpoint. So there's something very comforting associated with Ethereum and Bitcoin from a bearer instrument standpoint. You cannot be censored, period. There's nothing to censor the transfer of Ethereum or Bitcoin. So you own it. So are you more comfortable with the volatility? Or because frankly, I'm more comfortable with the volatility of those instruments, considering the fear of a bank taking my capital, and that's resolved. So the volatility is much more comforting than. You guys understand what I'm trying to say there? It is so discomforting, the experience I've had with this bank, that the volatility of these assets are more comforting. Probably not explaining that as best I can, but so I'm holding Ethereum as cash instead of USDC, and that's not something you've commonly heard from me. I have been talking over the last year or so, 22, about the significance of the cash position, but it was always USDC denominated. But that's changed. Maybe it's because of the bank experience that I'm describing to you. Maybe that's because the liquidity conditions are indicating that Ethereum is going to appreciate over the next 2-3 years. It's a variety of things, but that's generally my sentiment right about now. But I think of Ethereum as cash. I have bills and I'm spending things, spending money on things. I need to convert that Ethereum to a spendable currency form. And that's always the Bitcoin narrative that Bitcoiners talk about. You just have your Bitcoin and you spend it, and over the years it appreciates. So I appreciate that maybe, but I just think Ethereum is the faster horse, even considering the risk profile, the whole proof of work versus proof of stake narrative and argument. So what would I say with regard to portfolio composition heading into the next 2-3 years? You don't need much Bitcoin. I'm not accumulating Bitcoin. I have to have some, whatever your portfolio composition, your size is going to be relative to your portfolio size. So it's not for me to say how much, it's for me to say you should have some. You should have some Bitcoin. And I would say Bitcoin is the thing you don't sell, because Bitcoin, if you need to leave the country, if you need to move, if you need to do something that's radical and drastic, you walk across a border with 24 words or 12 words in your mind and you have money, because you could convert these assets to local fiat currency units relatively easily. Now, why do I say that? I've talked a lot about comfort so far this stream. In my mind, the capacity to be comfortable is worst case scenario. If I have worst case scenario covered, I could sleep at night. So you have some Bitcoin because you could do interesting things with it in a worst case scenario. Ethereum mostly does that as well. There is the proof of stake versus proof of work argument, but I find Ethereum much more useful. It's integrated into everything. It's much easier to spend Ethereum than it is to spend Bitcoin. Aside from transaction speeds, you throw Ethereum on a debit card and you convert it to USDC probably in about 3 minutes. You're not going to do that with Bitcoin. That's going to take at least half an hour, depending on how long it takes to get, uh, you know, a verified block to get to get on chain. So Ethereum is much more practical, much more useful. So I favor Ethereum. So with regard to cash, should I have some Bitcoin? My cash, which historically was USDC, is now Ethereum denominated. I have a little bit of USDC here and there, which I'm starting to feel uncomfortable about. I'd rather hold the Ethereum because it's a damn bearer instrument. No counterparty. No one's going to tell me whether I could transfer it or not. And that allows me to sleep at night. That's just weird to me that I'm more comfortable with the volatility of the asset considering the comfort it gives me that it's a bearer instrument. Okay, that's probably the best way to describe what I was having difficulty describing earlier. So this chart looks ridiculous. This is Ethereum versus the dollar on the monthly. And this further, so technicals are giving me comfort with the volatility, the potential volatility of Ethereum. So we spent the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. 1 year, 4 months in shit technicals. Zoom out to the monthlies. You're killing yourself on the dailies and the weeklies, and you're killing yourself trying to trade. It'll drive you nuts. So the depreciation started in December of 21. Oh, would you look at that? In November of 21, the Fed balance sheets, the liquidity domestically in the U.S. started to contract. Where's 21? Here. So this is a forward-looking indicator on liquidity conditions, international liquidity conditions. This is actually quite intriguing. July of 21 was previous resistance flip support on the monthly TWAP of the bond volatility indicator. So it was about 6 months out, 5, 6 months out. Well, it was 6 months, but June of 21. And then in December of 21, domestic liquidity conditions started to contract. And if you look on the DXY for December of 21, well, this was also a forward look, the breach of the TWAP to the upside on the monthly. So once the TWAP on the monthly for the DXY breached to the upside, there's the drying up of liquidity conditions. There's the drying up of liquidity conditions, July of 21. Notice the tight correlation between move to the upside and the DXY to the upside. Very interesting. Collateral and currency, because collateral outside the U.S. is currency. And then on the Fed balance sheet, you see the contraction, which is tightly correlated to the start of the decline of liquidity conditions as expressed by literally Ethereum and Bitcoin. So that was the top. December of 21, November of 21. So this is a great chart going into the next cycle where you could see a top. I mean, you watch the Fed balance sheet and you're going to front run the top by about a month or two. You watch move, you're going to front run the top by 6 months. It's a very forward-looking indicator, and the same for currency. So if you find correlation between resistance flip support on the DXY and resistance flip support on the move indicator the next time this is down, you're going to see a good 6 months lead time where the top's going to print on markets that are closely correlated with liquidity conditions. So it took 16 months for Ethereum to finally break back above the TWAP. January of 22, it breached below the TWAP. Held support, held support. Support, holding support is a position of weakness. And it finally broke through. It took 3 months to punch through the TWAP, and then it was down from there. But 16 months later, we breached to the upside. I mean, can't you just smell it in the chart? Can't you just visually inspect the weakness and the strength? It breached to the upside, it tried to push back down. It failed. Look at this next candle in May of 23. It tried to push back down. It failed. And look at this next candle. Tried to push back down and failed. And look at that. Look at this. Look at this candle. Look at this monthly candle. It was right on the T-Web. That is right to the penny. Look at that. You could zoom in. That is an incredible candle. Is that not an incredible candle? It's right to the penny on the T-Web. 1620. What a remarkable chart that is. That is incredible how right to the penny that is. Directionality. This chart, along with the confluence of move, breaching to the downside, leading to the DXY breaching to the downside, is confirming of directionality of Ethereum and Bitcoin to the upside. And you can have all your arguments about proof of stake versus proof of work all you want. One will do better than another. Does it really matter? Do you need the fastest horse? No, you need to be comfortable. That's the most important thing. Stop trying to necessarily make the most money. I've said that a lot over the last years. What you need to be is comfortable, because comfort and time is the equation for doing well over the next 2-3 years. You could have Bitcoin, it could do great. You could have Ethereum, it could do great. You could have some altcoins, they could do great. You need the time and the comfort. Otherwise, you're not going to be in the positions. You're going to be fearful, thinking of the dollar-denominated value, when what's most important is the directionality and being comfortable that the directionality is heading the way you want. What directionality is? Two choices, up or down. Do you have data suggesting it's going to continue going up? That's comforting. Buy shit and let it be volatile. There's a lot of potential volatility, commercial real estate, student loans restarting, but that's all domestic U.S. And I think even with domestic international, like relative to another country's domestic situation, with all their shit shows going on, I think international liquidity conditions scream flush. And that has to do with U.S. domestic fiscal requirements and Treasury issuance. So as Treasury needs to do its capital raise, it's going to flood international markets, which it's done. I think it's $750 billion they've already printed in bonds. And if you combine the printing of bonds and the decline of bond volatility, that equates to dollars printed outside of the U.S. Why? Because if you could print, especially with yields where they are, I haven't looked at Treasury yields. With yields where they are, there's the decreased volatility and the decreased price point, market price of the bonds, of the Treasuries. There's a discount relative to Forex, and that's why move is a leading indicator of dollar FX decline. Because you could print a dollar liability cheaper than you could buy a dollar on the Forex market. And that's the deal. There's your directionality there. USM2, this takes forever to move. It's a monthly chart. But eventually, this is a lagging indicator. This is almost a worthless chart to look at, in my opinion. It's just lagging. You just don't have the granular data. Move is much more informative about directionality of markets. This is just this. By the time you see this move, you're going to be late to acting optimally in markets. So Bitcoin has been outperforming Ethereum, as indicated by Ethereum denominated in Bitcoin. You could also look at it from a dominance perspective. But structurally, this is probably the most interesting chart going on right now in crypto. Zoom out to the monthly. Well into Guppy's region. So there's plenty of support below. Bit of an inverse head and shoulders structure. A little bit of a wick on this month's candle. I mean, structurally, this is the largest triangular compression maybe I could point to across many markets. And that's just an incredible compression. And there's 396 days remaining until we get to see the conclusion to this epic story of Bitcoin versus Ethereum and the price action between the two. I am very comfortable that Ethereum will significantly outperform Bitcoin, and that'll make people angry because they think proof of stake is inferior to proof of work, and that proof of stake is more consistent with the current status quo financial structure where folks with money make more money. But I don't see how that's not the case with Bitcoin as well. The economics of mining is purely capitalistic and dollar denominated. So I don't agree with a lot of the arguments of Bitcoin versus being significantly different from Ethereum from a fairness standpoint. Listen, if you have money, you could control more Bitcoin. If you have money, you could buy a significant part of mining operations. Or if you're a country, you can nationalize mining operations or eminent domain and just take it. So I see significant risk profile associated with Bitcoin as well that I don't see a lot of folks considering that are quite subscribed to the Bitcoin narratives, of which there's equivalent risks, considerations for Ethereum heading into the future. But I think just Ethereum is much more powerful from a functionality standpoint, from a software programmable money standpoint. See how Curb's doing. They'll hit the questions. 69 cents. Very nice. I mean, if you're a V Curve holder and you've seen the weekly revenue, it's been very nice since CRV USD came online, and it's just going to go up over time. Might be slow. Folks have noted that the interest rates on CRV USD are relatively higher as compared to other lending protocols, but people are still engaging with CRV USD to the tune of 8 figures, on its way to 9 figures, particularly because of the liquidation protocol implementation. It's very much favorable for longs because of the soft liquidation. And that's meaningful. I think it just grows. It might not grow exponentially, the amount of debt that's taken out on CRV USD versus like an AVE, but it will grow because it is more comforting to have that soft liquidation implementation as compared to a hard liquidation. So that's meaningful. I think the revenue is just going to keep growing, which is quite comforting. All right, let's do some comments. Gazika, hello. Risky Crypto, welcome back. Thank you. Tapsy, back in action. One Curious View. Peace. Brian, happy Monday. Zoidberg, Holly Folly, very interesting to hear you find Ethereum more reassuring than the banks. Yeah, I mean, if you walk across a border, you don't have shit. I mean, seriously, I know that's a bit of an extreme statement. But there's plenty of times, I mean, look what's going on in Africa and Sudan, and pick a country. You don't think about it often, but they thought about it in Europe less than 100 years ago. And over with First World War, you kind of want to leave. I mean, listen, there's plenty of reasons why you have to leave. Maybe you're in I don't know, maybe natural disaster, tornadoes, Hurricane Alley, or Florida and flooding, or a massive hurricane in the Northeast. Sandy was pretty bad on the South Shore of Long Island. Come on. The point is, if you need to leave and the bank is inaccessible, that's a problem. So there's something that's comforting associated with having your assets on a blockchain. So if you go somewhere else, that blockchain is still accessible because there's nodes all around the world. It's not dependent on centralized infrastructure of a bank, which can be disrupted to a greater degree than decentralized nodes that are everywhere around the planet. Chase doesn't have nodes everywhere. The scale and scope of the node network of Bitcoin and Ethereum is much greater than that of the centralized enterprise, and that is comforting. Brian, what are your thoughts on doing a wide ETH USDC, Uni V3 pool? No, I'm not interested in LPing. Listen, fine. If I had like 1, 2, 3, 4, 5 mil, and I could get like one, 200, $300,000 on an LP on a yearly. Fine, that's interesting. But if you're doing 10, 20, 30, 40, 50,000, you're not getting much. Listen, 5% on 50 grand. What's 5% on 50 grand? 10% on 50 grand is 5 grand. It's 2,500 bucks for a year. And an LP is going to be relatively volatile. And an LP has counterparty risk to a degree. Not necessarily at the contract level, but other actors that can engage with the LP. So I find it much more comfortable just to hold the bare asset. And that's what's giving me comfort right now. I don't even want exposure to a derivative. No SFRX ETH, no ST ETH, no R ETH, no none of that. I don't need any of that. I need to sleep at night knowing that I have assets that if I need them, they're there. And I could spend them on a debit card, or a variety of other ways to spend them. So that's my sentiment. Critical mass in the house. IF, good morning. Second set. Hey, Cap, are you leaning towards saying sayonara? Aura hasn't been doing so hot, but generally speaking, Lit finally, I think, found the bottom, which is nice. Lit is very productive. It needs to. I would like to see it appreciate. I'm not too worried about the volatility of the 80/20 balancer pool position for the VE lit, but 56% is quite nice to see. I'm not tempted to buy anything, even considering the bottom with regard to alts. I look forward to them appreciating, um, and I just want to own things that I think will survive. And I think the things that we've bought over the last year are interesting. And I know a lot of folks are probably watching this and are like, what to taking positions. That's a whole conversation unto itself. It's the hardest thing you could do is to take positions. But once you have a position, you don't have to do anything. You own it. And these positions that I have and we all have, whatever, CRV USD, says CVX CRV, or whatever the hell, what derivatives you own, will appreciate over time. And are they productive? If they're productive, that means they're going to be more productive in an increased liquidity environment, increased volume environment. They're going to be printing more fees, more cash flow. So this is quite nice. Uh, Nothing's available for me to claim. I cleaned the books. I got to go over. There's an Aura vote today. Wednesday is Bunny. You got to vote. If you have Frax v FXS, you got to vote there. If you have Balancer, you could vote. Stake DAO is where you do that. Nope, that's the locker. So there's been some good cash flow for Balancer, for some good cash flow here. A couple of percent. It's nothing to sneeze at. It's still meaningful. And then if you go over to Hidden Hand, markets. So here's your vote today. There's plenty of cash available. So these are good numbers. Anywho, Rupert, hey. Heath, holy cap, Mitch's curve leverage keeps on rising. He is now over 106 mil bar. What are your thoughts on the risk to the protocol, not curve price? Well, there's no risk to the protocol. There's risk to the price. If it gets liquidated, that's all the price. The protocol still does what it does, albeit a depreciated curve would mean depreciated yields on LPs, and that throws off the incentive to participate, albeit you still have the highly uh, enticing profile of the V2 with three pools. They're much more gas efficient, and obviously you have CRV USD from a functional standpoint in the liquidation mechanic. So there's plenty of risks in all of this, and your thought processes are probably heading or in the realm of taking positions, and I'm not there. So that's not where my mind is at right now. So I can't really speak to taking positions. We spoke today about predominantly our cash position, and my cash position's in Ethereum right about now, and that's why I started about directionality, and that directionality of the markets and the liquidity is making me feel comfortable with my cash being held in Ethereum. So I'm not really in a position to talk about taking up any new ownership. Maybe in the next couple of days or weeks. Check back in the next, 3, 4, 5 streams. Let's see how my sentiment is with regard to adding or buying additional positions. Hope that helps. Probably doesn't, but I hope it does. Hey Cap, how's FXS looking? Let's take a look. Look, it was at 4 and change. It's a nice bottom. Everything's put in a bottom as liquidity has improved. So the question with regard to entries, which we could come back to in the coming streams, is what's going to survive? What is systemic? Because anything that is entrenched, that has built some lendiness, will float along with the liquidity as it goes up. And I guess then the other question is, which is the fastest horse, which appreciates more? And that's just going to drive me nuts. So that's why we talk about over the years the significance of these protocols with regard to themselves providing liquidity internally within the crypto markets. And that's why there's CDPs and there's money markets like Aave and GHOs coming online. So we're going to have plenty of systems to facilitate liquidity coming from within crypto, liability printing from within crypto in the next couple of years, in the next cycle, certainly. And that should prove very interesting for the market dynamic. Certainly the volatility, because as you have leverage, and that leverage eventually capitulates, introduces significant volatility, but along with volatility comes fees. So there's going to be a lot of cash flow for folks who own parts of these protocols. I expect FVEFXS to become cash flow friendly over the next couple of years, which is I'm hopeful. I look forward to it because it hasn't been the most productive as compared to other protocols that we talk about often, Aura, Curve, so on and so forth. So I look forward to that. Buddy, hey Cap, so you're just holding ETH and not in a pool? What about CRV? What are you doing with that? Well, Curve, folks that come on my stream know that I have a relatively large VE Curve position. I acquired that position beginning of 2022, give or take. It was the culmination of 2020 and 2021 of doing whatever the hell we did in the markets, and that capital went to own a purchase of the Curve protocol. And you can't do anything with VE Curve. You can only claim transaction fees and claim vote rental fees. So I have no interest really in buying any additional Curve. I get tempted over the derivatives, the liquid stake derivatives, but I have not had enough motivation to allocate any. I haven't bought anything in these markets in quite some time, just accumulating cash flow. So that's what I do. I don't no ETH in a pool. It's just ETH in an Ethereum address, spot Ethereum, excuse me. I'm not really interested in an LSD right about now. I just don't need that 3, 4, 5%. I'm not interested in it. What, 3, 4, 5%? Let's say I have a 20 grand worth of Ethereum. I got 10, 11 Ethereum. What am I getting? 3, 4, 5%? A couple $100 a year? No. For that risk exposure? No. This is my cash. I need that cash. I need to buy things. I want to go on vacation in a couple of months. I need the cash. I don't want the exposure to anything. I want the bearer instrument that takes my money out of a stupid bank. I'm in control over it. So there's my comfort zone. I need to be comfortable with that cash. That's the deal. Hope that helps. CryptoTube, 15th June, BlackRock announcement of stablecoin low. Coincidence? Yeah, that's a I think these are good points. I mean, look what's going on in Hong Kong. There's some big things going on, and it's quite comforting because, frankly, the sentiment I have from my perspective and what I look at in the markets, I feel that it's other folks around the world finally seeing what I see. And that's not necessarily like, oh, crypto, it's a big thing. No, that's such a narrow mainstream media type of thing. Like, for me, I see these correlations with liquidity, and I see the significance of a bearer instrument, and I see these liability printers as compared to what traditional banks do and what Eurodollar banks do, and I see these as significant financial pieces of infrastructure. They're so powerful compared to what banks offer. I mean, look, I'm so annoyed with this fucking bank and these crypto protocols are a cure to that. Because, as I told my wife in that stream we did many months ago at this point, the first thing to learn to do with crypto is how to spend it. You need your debit card, you need your maybe a bank account connected to a Kraken or a Gemini or a Coinbase, and you need to know how to move your cash that's in crypto to a spendable card. Quickly, like in 5 minutes. You should be able to turn Ethereum into a debit card swipe in like 5 minutes. Come on. And that's the first thing to learn. And now what you're doing is you're breaking down how to actually use this shit in real life. And then you're like, oh, this is so cool compared to a fucking bank that hijacks your goddamn account for 2 years because you're not in control of shit. Anyway. IF, worth 4-year locking curve right now? No idea. I cannot, I don't have an opinion on taking positions. I can only express an opinion if I'm doing it myself. And right now, I don't suspect curve to depreciate from here. I think this is a massive year-long inverse head and shoulders. I think it's a bit of an Adam and Eve structure as this thing pushes above the TWAP. Notice it's still relatively bearish territory. It's below the monthly TWAP. So it's trailing Ethereum. Ethereum is leading from a structural standpoint. But as this goes up, curve will appreciate as well. I've told folks that I don't, when I what are my expectations for the price point of curve into the future? In 5 years' time, do I really give a shit if it's at $5 and it doesn't get past all-time high? And it just imagine it circulates between $1 and $5 for the next 10 years. That's something I would be like, oh, that's cool. I don't give a crap about the price of it. What I care about is the volume through the protocol and the cash flow that it offers. So the price is somewhat irrelevant. So in that regard, the cheaper the price, the better. So I expect my expectation for it is the volume through the protocol will far exceed any dilution that will occur due to the nature of the protocol and its currency recycling regime implementation. Does it go to $30? Does it breach $23? This lonely green line up here in the mountains. Who knows? If you're a VECRV, doesn't matter. You see what I'm saying? You can't sell it if you wanted to. If you lock VCRV, it decays over a 4-year period, meaning for 4 years' time, you have to have less and less cash flow access, less and less VE curve voting rights to gain access to the curve, to unlock, to sell it at the appreciated price point. 4 years of decay. I just don't see the equation there. For me, the VE curve is a purchase. I own a part of the protocol, and I expect the volume through the protocol to significantly outperform any dilution that's to come, which means cash flow up over time. Hope that helps. Will you cover how you are staking your ETH? I am not. I have spot Ethereum. That's where my comfort zone is. I need to sleep at night, and I am comfortable with Ethereum because Ethereum goes right to a debit card, and you could swipe it at a store in 3 minutes with a Juno account. BitPay will come back online when they do. And frankly, with stuff like Spritz Finance, you could get things to a bank account pretty quickly. I mean, Spritz is not instant like Juno, but Juno's been, it's been reliable for quite some time at this point. Big Pay worked very nicely as well, but they're going through some internal structural changes with how their tech stack works. So I look forward to them coming back online from a instant payment standpoint. Hilda's in the house. How are you? Always a pleasure. Gazika, Noah, when do you have this state of mind of accumulating productive assets prior to crypto? No, this is something that has probably 2021, so it's about 2 years and change. Yeah, this whole story that I've told you guys over the years is an evolution. It's been iterative, and ultimately, what brings me comfort is that it's a manifestation of traditional dividend investor methodology and mentality, which ultimately is the way Warren Buffett historically operated as an accountant. He's a glorified accountant. It's just buy things at hostile takeover prices, at distressed pricing territory, and you buy things that are cash flow productive, that are cheap. That's all he ever did. He bought an insurance company that was selling for pennies on the dollar because their balance sheet was fucked. So you buy it, you restructure the debt, and their business has all the cash flow. So you're buying the cash flow and getting rid of the debt because you just restructure it, you sell it, or do whatever, hostile takeover. And that, I think, is best expressed in the crypto markets now as compared to traditional equities. I don't think the cash flow of enterprise is palatable considering the risk exposure of the subjectivity of a human board, human resources, real estate, capex requirements, all of that bullshit that comes along with traditional enterprise. Meanwhile, the enterprise that we have access to here is software. No capex, no human resource expenses, no subjectivity of a board. You have DAOs and voting and software and deterministic execution of an enterprise. So that generally should explain that, Derek. Yeah, no, that's not Derek. That's Gazika, the state of mind and how I look at productive assets. So maybe I did have an interest in that years ago. I had a dividend portfolio for my father years ago. I didn't know the significance of all this as compared to the current state of mind I'm in right now. But this is a process for everyone to evolve the way they think of their portfolio and what it means and how it's structured and why they've structured it the way they've structured it. You always got to keep evolving. Derek, do you have any interest in CVX in the coming months? No. I'm likely not interested in any of the curve derivatives because I want to own the base layer. So some folks have called me a base layer maxi, and maybe that's the case. I don't need the derivatives. I don't. Well, I'm excited for them because they are part of the federation and they consume. They sterilize excess curve in circulation, and that's the whole point of this whole game, and that's why it's been working, because of the federated components, the sterilizers of excess supply. So, but I'm not interested in it. I don't need it. I get to sit back and watch Curve do what it does while folks rent votes and the cash flow from CRVUSD just keeps going up, and that's cool. One curious view, I can't sell my locked FXS until 2025, so it's not a mental burden for me. That's the biggest argument that I've been trying to make with regard to these deterministically locked positions. If you can't sell it, it was a purchase, which means, serenity now. If you can't do anything about it, train your mind that it's not a burden. It was a purchase. It wasn't a position to liquidate. Albeit, if you wait for the voting escrow to run its course, that's interesting. I'm not really at that point. I don't think like that. I think of these things as ownership, and I always up my locks. And I've been participating in these. I've been basically taking this money because no one else really votes. So I get, two, three, $400 a week here, and I listen. Stay humble. Listen, if you can get two, three, $400 a week, that's a big deal. An extra $2,000 a month, that pays what, a car? Come on. You don't need to. Maybe this is like that whole conversation of rich isn't what people think it is. That I appreciate that maybe more than ever. As 2022 taught me that stay humble and because that shit just got gross in 21, right, guys? These markets got gross in 21. That was crazy. It was like $100,000 a month in cash. That was crazy. Alan, you talk about staked out dilution the other day. The hypothetical user with 10,000 curve, if someone only has 10, 20,000 curve, would the liquid staking option and staked out be more profitable? Okay, so I often say position size is meaningful. And you have to make different decisions based on your portfolio size and position size. Um, Obviously it's hard for me to say what I would do if I had a position size that wasn't the position size that I have. But you're probably in a better position because then one, it's liquid. Do you need the cash? So an LSD, SCRV, or whatever the derivative is called for staked out. That's cool. I think staked out has been outperforming what Yearn and CVX CRV. Staked out has been actually doing very well. It really, staked out didn't start where it is right now as an LSD accumulator. But they really pivoted and made some nice changes to the point where the vote market is the primary market for Curve. This implementation right here for the vote market, this is pretty much everything from a Curve ecosystem vote rental standpoint. It's a big deal. So yeah, that kind of size would probably be an LSD of Curve. Stake DAOs, the liquid derivative, whatever it is, and CVXCRV, stuff like that. Y curve. But that's a very subjective choice to make. Smaller bag holder, since you said you are required to claim weekly with the marketplace gauge option, it seems like claiming $50 to $100 weekly reward would be eaten into greatly by gas costs. Yeah, so you probably want like auto compounding, and you probably want one of those liquid derivatives. That sounds about right. That sounds reasonable from that perspective. Because if you're doing vote market, you got to claim weekly with regard to Curve. But if literally, I just closed it. I just closed that too. Hold on, I'm coming. History, stake DAO. So what is it? Oh, that's VESTD, which doesn't pay much. But they're SDVCRV. That's what it's called. All right, 20, 30, 40%. That's crazy. Massive numbers. And it's curve exposure. And you get the vote. So that's cool. What an ecosystem. It's absolutely astounding. The depth of this ecosystem is very exciting. Hope that helps, Alan. Austin, hey, no, I know it's subjective, but what is the minimum threshold in your view that one would need to be effective on the Ethereum blockchain from a gas fee perspective? Oh, I don't know. Listen, you don't need to be doing transactions. You could just have Ethereum on the Ethereum network. That's a big deal, and then you're not spending gas. And frankly, if you're using stuff like CowSwap, there's no transaction fees. It's free. It's a signature. You're just doing approvals, and there's no transaction. Everyone who ever said it's so expensive to trade on Ethereum, it's free to trade on Ethereum mainnet. You just never use the limit orders of 1inch, the 0x, Maca, and CowSwap. But this is probably one of the most interesting swap protocols over the last years. And obviously the meta aggregator from DeFi Llama is great, but the signature-based swapping from CowSwap, this is just a very impressive implementation they've built. So this is it. There is no reason to swap using anything on Ethereum mainnet between CowSwap and checking on maybe DeFi Llama, but the odds are it's like a couple bucks difference, and you might as well I just use this most of the time. CowSwap is serious stuff. So what kind of size? I don't know. I have no idea. Uh, all I know is you got to spend money to make money, and you know, 10, 15, 20, 30, $40 transaction fees. You need to train yourself that that's the expected cost of operating. So that means you have to base your activity around those capex requirements. 10, 20, 30, 40, 50, 100 grand. I mean, you're not going to get this kind of exposure on the L2s. You're going to have additional counterparty risk, multi-sig exposure risk, bridging considerations. That's getting resolved over time with Frax being native on the other chains, USDC being native on the other chains, Tapioca coming online, which will be native to layer 0. So there's considerations there. So things are improving. I don't know how things are going to play out from an Arbitrum and optimism standpoint, but that's where the activity is on other chains. But you have different considerations, different risk considerations. This is the reason why this is so hard. This activity that we do is because there's 10,000 considerations, and of those considerations, there's just various. It's just infinite considerations, choices to make. So the way you must proceed is to simplify the equation, because otherwise you're never going to find comfort engaging with these markets unless you simplify the equation. So what are ways that I do that? I invalidate other chains for significant exposure. I'm like, I'm going to operate on mainnet, and the other chains, I don't need to operate on them. So you may do that. The opposite of what I just said. You invalidate Ethereum mainnet and you focus on Arbitrum, and it's still the same assets that you're looking at, and you just either have that functionality that's implemented over there or not. You have to invalidate positions, reduce the amount of options and choices that you can make, and that's the only way you're going to be able to find comfort to engage with these markets long enough to be successful. Simplify the equation. Hope that helps, Austin. I know you always mention it may not be rational to maneuver with a small allocation. Yes, that's correct. You have very different considerations with a small portfolio. With a small portfolio, you probably want to be more concentrated and less diversified. And that's obviously a complexity, which means you might not have exposure to certain volatile assets that are asymmetrically or have asymmetric price appreciation potential, like altcoins. You don't want to have over allocation to an altcoin and have the narrative be invalidated. So that's greater. Smaller portfolios must expose to greater risk in order to reach expectations. Either that or invalidate expectations or restructure expectations. And if you're exposed to Ethereum, there's little to no risk other than the volatility. The directionality is clear from a 10-year standpoint, but you don't have just little to no doubt as compared to altcoins about the directionality, about the risk profile, about it existing. It's going to exist. It's going to survive, and that's a very different argument with regard to would you concentrate to Ethereum? Sure. Will that underperform many altcoins? Yes. And therefore you have to adjust the expectations. Complicated. Hope that helps. Alan, great minds think alike. A pleasure, Alan. It's hard to be rational with these markets because of just how many options and choices we have to make. Raul, a pleasure. One curious view would aim for aggregate transaction fees less than 2% of allocation amount. Now, this what you just said is very helpful. Rules, constraints, thresholds for invalidation. If you need to write this shit down, write it down. And I remember folks telling me this years ago, like, have a strategy, have rules. And it's funny, it takes years to really understand what the hell that means when someone says it to you. But look, we just said three very meaningful rules. Like the most important thing I would argue is to invalidate things. And that simplifies the equation significantly. Raul, it's a good question. I don't think anyone asked that today, but folks have probably interested. Yeah, I'm going to probably relock. I mean, that's real. That's coming up really soon. Let's see. We'll take a look together. We're a little family here. We could take a look. So I claim that lock. So the lock, 28th, 2 days. Woo! Somehow I'm number 55 top aura position with 0.26%, which is relatively small. It's bigger than my curve ownership. Close. I'm probably going to lock. Wait, what the hell am I going to sell it for? If they just expand it to Arbitrum and they literally are doing everything, there's nothing about the narrative that is invalidated. If anything, they're heading in the right direction. So comfort is there, directionality is there. The only reason to liquidate is it's depreciated. That's not an invalidation of its narrative. So I literally have no rational argument to liquidate. So therefore, I must relock. It's the only rational course of action. Hope that helps, Raul. 40 people in the stream. You all made it to the end. I thank you so much for joining me. I appreciate you guys listening to my ranting and raving and all this stuff that hopefully helps us all do a little bit better in these markets that have infinite choices and options and that drives us all mad. So invalidate those choices. Find reasons why you can't engage with a market or you shouldn't engage with a protocol. Find reasons to invalidate choices and options to simplify the equation, and that should make things easier. I look forward to this directionality continuing on markets. These charts look great. Check back at the end of the week, 4 days, 8 hours for this candle body close on the monthly, and that'll bring us greater comfort. Especially if this chart closes green above the open, which is basically, you just saw it tick red and green, 1874. That would be even more comforting because candles matter and closes matter. So this is going to be a very interesting summer, basically, what I see in the data. So stick with it. Find your comfort zone so you can survive. And I will see you Wednesday of this week. Tell everyone to subscribe. It can only help people if they actually listen. And you know the deal, after party on Discord for the most rational community in the entire crypto space. I will see you guys Wednesday. Peace.